Welcome, everyone. Thank you for joining. I'm Layla Taha, Executive Director of the National Flood Association, and I'm pleased to welcome you to today's session, Navigating the Ever-Changing Flood Industry Requirements and Regulations. As a brief introduction for those who may be less familiar with the National Flood Association, it is a national nonprofit trade organization that works to advance the common interests of the flood risk management community. Our membership is comprised of a diverse group of flood stakeholders representing insurance, lending, flood mapping and data, claims, and other segments of the market with a vested interest in flood-related topics. As part of NFA's mission to foster education, open dialogue, and collaboration amongst flood industry stakeholders, we're offering today's session to provide insights into key developments in flood insurance with a specific focus on the impact to lenders, consumers, and financial services stakeholders. Before we begin, we encourage you to enter any questions you may have during the presentation into the Q&A session of this platform. Also, if you're a certified compliance professional interested in earning 1.25 continuing education credits from the American Bankers Association for attending today's session, we will be providing you a link at the end of the session to sign up to receive a certificate of attendance for submission to the ABA for credit. Also, for your reference, a recording of this session will be accessible on demand on NFA's YouTube channel within the next week. It is now my pleasure to turn the floor over to Patrick Sullivan, Vice President of Industry Relations and Compliance for Lending Solutions at Assurant, an esteemed NFA board member who will be moderating today's conversation with this expert panel. Patrick?
Thank you so much, Layla, and welcome to all the participants today. Good afternoon here on the East Coast. Central Coast, you're probably just sitting down to lunch, and good morning to our Mountain Time and West Coast participants. Again, welcome to the NFA webinar. Today, we're going to review a number of topics that impact mostly the lender, but in that whole, as the title says, navigating industry requirements and regulations. So we're going to hit updates on New York legislation. We're going to talk about clarifications that the industry is seeking on the interagency questions and answers. We will get an update on the Florida insurance market and some Florida flood map updates that we expect that actually have some have occurred late this year and then moving into next year. And lastly, we will talk through the pending updates from the GSEs on insurance policy. So we plan about 45 minutes for the updates, and we plan about 15 minutes of your own questions. We want this to be somewhat interactive. Please submit the questions, as Layla mentioned, through the Q&A function on the Zoom meeting. And we will answer those questions as they come up. So again, feel free to jump in with questions as we're working through the issues. So very happy to have as panelists today. We have Heather Wright from Bradley, Arendt, Bolt, Cummings. We have Tashale Smith from the American Bankers Association, David Wolter from Newmark. All of them are on LinkedIn. I suspect many in the audience today are familiar with these individuals already, but they are true subject matter experts, certified floodies, fluent in all things flood and flood compliance, and pleased that they're here to provide these important updates as to whether the governor has signed or not, which would be really great for the webinar if we had a live breaking news update that the governor signed the bill. But apparently it is on her desk awaiting signature. And so when we went through that bill, there are a number of industry concerns with, based on our experience with Massachusetts. So we had put a work group together, and the NFA did prepare it essentially was an informal comment letter, which outlined a number of those concerns. So Heather Wright was the legal genius that helped us with all the correct legal prose on that letter. So we thought, Heather, can you jump in here and give our audience an update? One, the key concerns that industry sees with the bill in New York and some of those implementation issues. Also, talk about the development of the letter itself, the work group and that process for how we put that together. And then now some key steps that lenders and servicers need to take to be prepared for implementation once New York signs the bill.
Happy to. So it's always interesting for those of us in the flood space who live primarily with the NFIP and FEMA and the FDPA for there to be states that want to enter the fray of flood insurance. And so This is a bill that, Patrick explained kind of where it is from how a bill becomes a law procedural standpoint in New York. We don't really have any expectation that it won't be signed. I think our expectation is that Governor Houchin will sign it in New York. But basically, what it does is it prohibits a mortgagee on residential. We're only talking about residential, which is one distinction from the FDPA. But it prohibits a mortgagee from requiring a borrower to have flood insurance limits that exceed the outstanding principal balance of the loan, number one, or that require the borrower to have coverage for contents. So one of the things that's interesting about and Layla has just put up the link that'll have the text of the bill. But one of the things that's interesting about particularly problematic for lenders is number one, there are the limitation on contents and not being able to require contents if those contents are security for the loan is that directly conflicts with the FDPA, which specifically requires lenders to require flood insurance for contents if they are security for a loan. And that doesn't often come up on the residential side because there aren't really many residential lenders who utilize form loan documents that take security in contents. However, I'm based in Nashville, Tennessee, and we did have a bank here recently who had some FDPA trouble because their standard loan documents were taking security interest in contents. And so for folks who are in New York who have loan documents that may automatically include contents, even on residential loans, or maybe there's a question as to whether a loan is residential or not, or whether it is a commercial loan, if it's a condo, live work type situation. But in New York, you cannot, assuming this bill becomes law, require a borrower to have flood insurance on contents. There are also questions that we have about how this is going to apply to HELOCs or to reverse mortgages where the balance of the loan fluctuates. Do you require flood insurance only on the actual amount that the borrower has taken out on a HELOC? Or do you require flood insurance on the limits of the HELOC? That's not an issue that is unusual in flood. It's something that we talk about all the time, and that is covered by the regulators in their interagency Q&As. But it is an issue that is going to require constant monitoring to some extent of what the balance is and what your ability to require flood insurance is. Another issue that is, again, not unique to New York, but that comes up under the federal regulations as well, is when there are multiple liens on the property. Who's going to be responsible for communicating with the borrower? How do you determine what the specific limits are that you are limited to requiring the borrower to have if they have multiple liens on a property? And what if one of those liens is a HELOC that can increase? So a lot of the same issues that we see on the federal side, but just an added layer within New York. We do understand, Patrick's group has been talking to the governor's office. We do understand that there will be a notice and comment period once assuming the statute is enacted into law. The Department of Financial Services in New York will then have the responsibility of creating rules and regulations in order to support the implementation of that. Right now, the statute says that it is effective immediately. For those of us on the lender side, anytime something's effective immediately is terrifying because our systems just don't operate that way. We have been assured that, at least in informal conversations with the governor's office, that effective immediately doesn't really mean immediately. At least as far as we know, the Department of Financial Services is going to have to get up to speed with rules and regulations, which will have a notice and comment period, which leads me to what the NFA has done on this issue. As Layla mentioned, some of you may not be familiar with the National Flood Association. It has been, for me, an amazing organization to participate with because it's not limited to lenders or insurers or floodplain managers or claims folks. It is everybody across the industry who could possibly be impacted by flood. And with the climate change we've experienced over the last several years and the increased severity of storms, the flooding well beyond the 100-year flood. I lived in Asheville, North Carolina, and just got for several years, and just got some pictures from a friend of mine yesterday on what Biltmore Village looks like 2 months after Helene, and it still looks like a war zone to some extent there. So the NFA has lots of impact on the industry, the ability for us to be able to send a letter to the governor's office explaining what the issues are, to schedule calls with the governor's office to discuss implementation, and then be able to work together on, during this notice and comment period, provide guidance to the folks at the Department of Financial Institutions in New York, and explain to them what the operational issues are for servicers, those of us who, and lenders, those of us who are in the flood space on the lender side. We recognize that one sentence in the FDPA about our event, and you've got to have flood insurance, or require the borrower to have flood insurance if you're in a special flood hazard area. That has created, as we all know, 80 pages of questions and answers on what exactly that sentence means and how does it apply to various different situations. And so one of the things the NFA is committed to is making real change in not just for lenders, but for anybody that's impacted by the flood industry. So if you're at all interested in the lender impact, how lenders are impacted, there's a lender committee within the NFA, and these are the types of problems that we're trying to tackle.
Excellent. Thank you. And then there was one question in the the question and answer: is residential for this purpose number of units 1 to 4? We don't know. That was one of the definitions we're asking for. In the letter prepared by the NFA work group, we asked for a number of terms to be defined, and hopefully there is already existing code in New York that they can cross-reference to, and that's what happened in Massachusetts. When this bill was a very similar bill passed in Massachusetts, it took about a year for the implementing rules to come out. And the Department of Banking did come out with a frequently asked questions document, which was very helpful. We actually provided a copy of that to New York and said, like, here are all the things that industries are going to ask for, and here's why we need to know these things. So residential was not defined. It's just a very broad statement in the bill. One of the definitions we've asked for.
And Patrick, that reminds me, I forgot to mention one of the things that we asked for is for there to be a model notice.
Yeah, the model. The model notice is really big, and I think in Massachusetts, I think everybody, when we had to implement that in terms of font size, in terms of from a proving compliance from an ask standpoint during an audit examination, from a safe harbor standpoint, a model notice would go a long way. We had that conversation with the governor's office, so hopefully that's something we can work with New York on. And so, yeah, and great promo from Heather. I mean, I don't want to, the work group that put this together, just a great collection of thoughts. So shout out to Shale and Sarah and at MBA. Your assistance in collecting and relaying the concerns from your constituents, super helpful. There was very constructive phone calls on that work group. Heath Portwood from National Risk Brokerage managed version control. Heather, we talked about, you put a lot of what we were talking about into legalese, which was beneficial. So just a great work group, something that it's open to non-members. So if that's something that interests you in the future, drop us an email and we'll get you plugged in. So we talked about thank you. So, hey, thanks again, Heather. in that background there, we heard about, some of these answers are in the Q&As, or some of our issues are in the interagency Q&As. Is there a question? No. Okay. And so let's pivot over to the Q&As now, right? They serve as guidance for lenders and servicers on a lot of these flood issues. We rely on the interpretation from the prudential regulators. It assists in our decisions. It helps us design controls and processes. But there's also a regulatory obligation for those agencies, for the interagency prudential regulators, to update those Q&As regularly. And the last update we got was the big one in May of 2022. We now have 144 Q&As, and they're all relabeled and organized, but we really envision a scenario where updates to those questions and answers are more frequent, and we want them to reflect current circumstances, evolutions in the industry, market updates, emerging case law, and then also trends in enforcement. And so, to Shale, earlier this year, October, ABA prepared a very comprehensive comment letter to the agencies under the notice and comment for the Paperwork Reduction Act. And in that letter, you highlighted 7 of the questions and answers where industry is still seeking some update or clarification. Can you walk us through those and also speak to the process of developing that notice and comment letter itself?
Yeah, sure. Thanks, Patrick. So the comment letter Patrick is referring to is what we call our AGRIPA comment letter. So just to give a quick background, so AGRIPA stands for Economic Growth and Regulatory Paperwork Reduction Act. It was passed in 1996, and it requires federal banking agencies to review their regulations every 10 years to identify any outdated or unnecessary requirements or anything that would impose an undue burden on entities regulated by those agencies. So there's so many different regulations, of course, by these prudential regulators. The comment process is typically divided up into different areas. Flood insurance falls under the consumer protection area. And so this is the one that was due on October 31st that we filed. And a link to our comments, as you can see on the slide deck here, can be found there. And there's you should be able to easily access that without having to log into our website. So yes, we do this every 10 years, the process. We did this 10 years ago, back when, before the 2022 Q&As were processed. And we asked during that time to, again, update the Q&As more periodically. But just as FYI on the process, after the comment process concludes on the AGRIPA, the agencies then typically create a report to Congress on what they can do in response to the comments they receive. So we'll see what we get from the agencies and their report to Congress to see if they take into account, the things that we said in our comment letter, asking for clarifications in these areas I'm going to talk about in a second, and updating the Q&As. We did note in our letter that, last time they were updated before 2022 was 11 years ago, and how that is absolutely unacceptable, especially in an area that has such strict penalties for non-compliance. So we do reiterate again to Patrick's point that you need to provide clear, comprehensive, regularly updated guidance on flood insurance through a notice and comment period. So we do have 7 areas that we go through in the AGRIPA comment letter where we have heard from our members that there is mass confusion over and that the Q&As are not meeting the needs. And then we're going to talk about 4 areas first, and then I'll talk about the other 3 areas where we just pretty much made recommendations in areas where it just doesn't make sense for the Q&As to say what they say. So first, on the first area, is this big issue that we've been seeing around forced placement as it relates to advanced map-ins. So forced placement Q&A states that when an entity receives advance notice that a property will be remapped into an SFHA or a special flood hazard area, the effective date of the remapping becomes the date on which the lender or a servicer must determine whether the property is covered by sufficient flood insurance. Well, we noted that this Q&A lacks clarity on whether the agencies are suggesting that lenders must align their determination insurance sufficiency with the future effective date of the map change, or whether the lender's determination date itself establishes the effective date for insurance coverage. Essentially, when is the bar expected to have insurance in place, and what is the start date of that policy. If it is the former, where it's based on the future effective date, well, that does not really give lenders enough time to go through the process of determining how much if that policy or if that loan, it does have insurance sufficiency by the effective date. When advanced mapping comes in, there's all these different steps that lenders and servicers must take. They have to go through their full portfolio, figure out which loans are affected, evaluate those loans for sufficiency. That is a lot of steps that needs to be done before, and it's possible that the effective date has already essentially come into place. So we recommended that the agencies, include an example with specific dates and clearly defined terminology to illustrate the prescribed effective date of coverage following a map change. And then also to keep in mind that when the borrower obtains their insurance, they can only obtain coverage prospectively. And also to keep in mind the extensive process as they're determining which one will be the actual effective date of coverage. Any questions there, Patrick, before I go to the next area?
I do not see any in the chat, and I do not have any. Yeah, that was a real big topic of discussion last year at the NFA conference. We had a lender breakout group, and really appreciate you taking those comments and running with them all year to get it into the comment letter. But yeah, it's just an odd interpretation from the interagency folks on I think how they think that map process works. But you described it very well. Thank you.
Yeah, no problem. And someone did say that the comment letter on ABA's website is not accessible. We'll make sure, I'll talk to IT to make sure there's no paywall there and make sure that's fixed, because all of our comment letters should be accessible to the public. Okay, on to our next topic, and this topic is actually another one of Heather's big areas that she is our top expert on, and it's related to collateral not taking as security in the loan documentation. So the big area of confusion in this on this matter is whether personal property in a special flood hazard area explicitly excluded in the loan documentation as collateral is covered by the FDPA's mandatory purchase requirement. So that's a lot of words to salad. Essentially, what we typically see is that you'll have a standard loan document that takes all assets initially. And then later, lenders may attach a rider to those loan documents, excluding personal property or contents located in a special flood hazard area. Now, the flood regulations state that flood insurance coverage under the Act is limited to the building or mobile home and any personal property that secures a loan. So essentially, these riders that are later attached exclude that personal property. And so they are not collateral that secures the loan. This should be enough to negate a lender security interest in that property and therefore release the lender from the obligations under the FDPA. So, again, as the law focus on what collateral is securing interest for that loan. However, that's not what is happening. That's not how the regulatory agencies are interpreting that section, and have said that it's not acceptable to use this rider to exclude your security interest in that personal property, and that you're still required to get flood insurance on that property. So we did recommend in the agencies that they in our agency Q&As, because there is some seem to agree, some don't. Even I've met with some of the regulators, and again, depends on who I'm talking to, is how they decide whether or not they agree with whether or not you are required to have flood insurance on something that's been excluded by a rider. So we ask them to, make sure you update the Q&As and clarify in them that this industry practice properly releases the security interest in personal property or contents, and thus exempts the entity from the mandatory purchase requirement. That is the interpretation that makes sense to us, also the one that makes sense under the law. Because if you have a borrower that, for example, has personal property, but they don't actually own it, for example, they lease it, they wouldn't be required to get flood insurance on that, because they don't have any ownership rights in it. And how does a lender have any right to force a borrower to get flood insurance on property that they have no interest in? So again, we have been dealing with this issue for some time now, but we wanted to make sure that it was in our Agrippa comment letter because it continues to come up again and again in examinations. Heather, did you have anything to add?
Yeah, there's a question in the Q&A. Somebody said, is that considered a carve out? And that's a good question. And basically what we're seeing from the regulators is, or let me start a little bit before that. Folks have on, let's say you're a very large bank and you have a standard form security instrument that you use for any commercial loan, because although it does can come up in residential, we're really talking about commercial here. But let's say you've got a commercial loan that form that you use for anything 5 million or below. And that form is, as a lawyer, the lawyer is always going to want to say, we need everything as security. Like if I'm representing a lender, I want the most security possible that can be collected on in the event of a default, that we can foreclose on, take possession of, sell, whatever. So the issue here is your loan agreement says, yes, we're taking collateral of everything. To me, a carve out would be in that loan document, I'm specifying I'm not taking this collateral. I'm striking through that provision within the loan document. So I am carving it out from my collateral. The question is, can we do that through an addendum to the loan documents? That basically, so you have a loan document that says, I'm taking everything as collateral, including the kitchen sink. Well, that's probably not an example because I think that's a fixture. Including inventory. I'm taking that as collateral. And then I have a piece of paper. So my loan document says, yes, I'm taking everything. But I'm adding a piece of paper at the back that says, oh, by the way, if this is in a special flood hazard area, I'm really not taking contents. I think what we're hearing from some regulators is that that doesn't work. And I think the reason they're saying it doesn't work, and again, this is my projection, I think what they're saying is, well, you can't take it in as collateral and then in the loan documents and then take it away by a writer. Yeah. If you're going to carve it out to answer the question in the Q&A, then what you really need to do is just never take it in the loan document to begin with, like that you would redline out the sentence where you're taking contents. I think that's the distinction that they're trying to draw.
But that's odd because they say you can carve out detached structures.
Exactly.
So I don't understand. They seem to say that you can carve out this item, but not this item.
But not this item. And legally, to Shell's point earlier, if you can't foreclose on it, like if we have, as a lender, if we've got that rider on our document that says we're not taking contents as collateral, if I were to then try to foreclose on that, the borrower would rightfully have an argument. You don't have a security interest in that. It's in a special flood hazard area. You didn't take it. So I do think, though, and then I'll stop talking about this because, as we have said, this is one of my pet issues. I do think there is a distinction between doing it at the time of origination and adding that rider at the time of origination and trying to add it post-origination. I think that gap period, whether it's through a modification or through I know some people who, when the Q&As came out and it was very clear that contents is contents, whether it's a perfected UCC1 or not. And if you've got a security interest in it, you have to have flood insurance on it. I know folks who, after the Q&As came out, were trying to correct their FDPA compliance by adding riders to loans post-origination. I do think that in that gap period, you've got an FDPA violation between when you originated and when you put that rider on. But this is an issue that we're working on, and maybe an issue for NFA to work on. Now that I think about it, something to add to our list, Patrick. Okay, I'll stop.
We'll add it to the list, and again, April 7th and 8th, Scottsdale, Arizona. There'll be a lender breakout at the NFA annual conference. So I'm sure this will be one of the issues on the list. So Tashelle, where do we go from here on the Q&As? Again, it's probably just a monitor and see if they get modified by the prudential regulators.
Yeah, so like I said, after the comment process, they typically send a report to Congress where we'll see more about what they plan to do. And again, a lot of the time previously we didn't get much out of them in the report, but of course we did get the May 2022 Q&A. So after we commented in 2015, so I suspect that we'll have a report. They'll say probably some very vague and ambiguous comments about how they're gonna periodically update the Q&As, but I think we have to, ABA, NBA, NFA, have to keep pressure on the regulators to make sure they are and holding them accountable to keep updating these Q&As, because that was just two, and I know we're short on time here, but there are so many different other areas where the Q&As are just not clear enough. And again, in an area with like flood compliance where the penalties are very strict, they really do need to make sure that the guidance is very clear for lenders and servicers who are subject to these laws, so that they are making sure they're able to comply properly.
Yeah, thanks. And you mentioned, one of the factors that drives the need for updates to those Q&As are just the changes in the market, the changes in enforcement, the changes that we see even from in terms of consumer behaviors and things like how you add or don't add contents to loan policies or to loan agreements, excuse me. So, again, one of the things, one of those factors is it changes in insurance markets. So we're going to pivot a little bit and, move to a quick discussion of the dynamic situation that is the Florida insurance market, probably one of the more dynamic insurance markets in the state. State leaders in Florida have wrestled with full private participation in their state for decades. You had the Joint Underwriting Association years ago. You've got Citizens now. There's been iterations in between. Citizens is the leading carrier in the state in terms of market share. Special legislative session in 2022 addressed very needed reforms, both on the litigation side as well as the policy structure side. And this year we've seen some signs of stability back in Florida. So David Wolter, not only an industry expert on mortgage and flood compliance, one of our affectionate floodies from my opening comments, but David's also a Florida resident, and unfortunately, after the last storm, is all too familiar with the insurance ups and downs in that market. So David, can you give us just a quick update of where we are in Florida, update on the market, and then I've got two follow-up questions for you.
Sure. Let me throw out some numbers, and this is kind of scary in some ways. According to the Insurance Institute, only 25% of residents affected by the storm had flood insurance. I was able to piece together by county the amount of structures that showed flood damage. I think it's like 30,000. I'm sorry, 300,000.
300,000, yeah.
Which tracks right into the number that we have 72,000 claims, NFIP claims, from both Helene and Milton, and a total of 92,000 this year from other storms, which is Beryl, Debbie, and Francine. And we've gotten hit by 5 storms this year. They're now projecting a total loss for NFIP on these storms of about $10 billion. Not only that, the private insurance market's got whacked pretty hard too. The ORI is saying that they had, let me find this little factoid here. Here it is. They've had 1,600 claims already. They're expecting something like 2,000 claims, and they're talking about $500 million in damage. While we had a stabilized market, I think that got wiped out this year. It'll be very interesting. John Doyle, CEO of Marsh McLennan, says the impact of Helene and Milton will likely influence property insurance and reinsurance pricing in 25. Close time and extensive damage will challenge recovery efforts and strain industry resources. From a personal perspective, Citizens requiring the flood insurance on every one of their wind policies has been a good thing. The sad thing, down the street from me, a guy who literally got wiped out, they only covered his building, did not provide any contents insurance, even though he thought he was paying for it.
Hmm.
So that's a lawsuit waiting to happen. Heather, you might want to talk to this guy. But what really is traumatic is, of these 300,000 buildings, less, 200,000 probably have uninsured losses. And watching these people struggle to recover, and there's another guy around the corner from me who didn't have any flood insurance, and his house was completely wiped out. He just now is barely moving back into his house, and it's really sad to watch. I mean, it's been devastating. In terms of the private market, they are very, very selective on what they're deciding to insure and not insure. As a complete picture of this, they won't insure my house, even though the first floor is at 17 feet. It's also in an AE zone and 1,000 feet from a major waterway, and they're not doing it. So it will be very interesting to me to see how all the little private companies that came into the market and that were actively taking the portfolio from Citizens, how they all react to their losses.
What have we heard so far? Because we had about 10 or so move into the market in the last year. Some of those were very niche. Some were condo only. Some were so. I'd say about half of those were probably what we'd describe as mass market type carriers. Have we heard the damage they or loss estimates for the new guys?
This is just that same comment, over 500 million in loss adjusted expenses, with maybe 300 for Milton, 300 for Helene and 200 for Milton. And they've got, 686,183 claims filed through November 8th.
Okay.
So,
yeah. And then you mentioned there's the citizens requirement. So policies obtained after July 1st of last year, and then 2023, and then everything for 2024, 600,000 coverage amounts of 600,000 and above. Those citizens policyholders had to get flood. For this year coming up for 2025, it'll be 500,000 and above. And so when we think about Hurricane Harvey, or Tropical Storm Harvey, excuse me, in the Houston area in 2017, as you mentioned, a lot of uninsured flood damage in Florida as well. You see that uninsured flood damage outside the special flood hazard area. Do we think this citizens requirement to have a flood policy, now that it's lower, now that it's approaching that $500,000 mark, do we expect an impact? Do we expect to see less of uninsured flood loss because of this, or is this just a depopulation tactic for citizens?
both. I mean, if you can't, if they depopulate, if they depopulate and they are no longer required to have the flood insurance, they're not going to buy it.
Yeah.
And if they stay in Citizens because the private is too high, which in a lot of cases it's higher, then they have the added cost of the flood insurance. So I mean, all in all, they end up getting better coverage if they stay with Citizens, but it's at a cost.
Okay. And then there's a comment in the Q&A that apparently your feed was breaking up a little bit. Can you repeat the total dollar amount of claims from I believe it was the 5 storms that you quoted?
The total amount of claims from which one? I'm sorry.
The claim amount you quoted.
For private is 500 million.
500
The
million.
total amount for FEMA is going to be 10 billion, between 8 and 10 billion.
Okay. Okay. 8 and 10 for FEMA,
Yeah,
500 for private.
Right. And that happens to be something like 200% of what they had available. So it's not a good number.
Okay.
200% loss ratio.
Right.
The other thing that is somewhat interesting, Fort Myers Beach, and I think Fort Myers and Lee County are all now on probation, FEMA probation, for violating the 50% rule. They allowed a lot of residential houses to rebuild without and spend more than 50% of their cost without elevating. And you're going to see a lot of that in the future. I think everybody, it's because that FEMA has put Lee County on probation. All the other coastal counties in Polk County and all these other places where the flood went inland are now going to be very, very careful about what they let their residents build and how they permit.
Okay.
I'm seeing games played with contractors and the 50% rule all over nearby where I live. And it's not a good thing. And it's something that lenders are going to need to watch out for.
Yeah. And so speaking about, changes lenders need to watch out for and changes in population, we have map changes as well.
Yeah.
We had an NFA webinar earlier in the year on changes in Broward County and parts of Palm Beach County. But can you give us a quick update? Those are a little more real now. And then are there practical steps lenders and servicers should take? And Heather, you probably have a couple of those in your compliance checklist as well. Can we talk about the remappings for a moment?
Yeah, so
Yeah.
one of the, I didn't know if David wanted to go first. Sorry.
Sure. I'll just
Go
tell
ahead.
you there are
My bad.
88,000 new properties in Broward. And
88,000. Yeah.
alone. And it'll be interesting to see how many extra new properties get added in South Florida. And, the maps, we've got more than 3,000 FEMA maps that are more than 15 years old. Little by little, they're getting updated. And after this last set of hurricanes, those maps are going to look significantly different. So that's going to create a lot of stress for lenders and servicers. I mean, 88,000, if you just happen to have 5% of that population, you've got a lot of work to do.
Yeah, the numbers themselves are daunting. And whenever I'm litigating a case for a servicer, primarily, I have to explain to a court that because this is what people's what they envision. They envision that a servicer has a room full of cubicles where there are 300 people working, and each of those people is responsible for 50 properties. And that those people are just constantly monitoring every day what's happening with those properties. And that person, that mythical person, would get a flood determination letter, and they would say, oh, this affects David's house. And now I know exactly that is not how servicing works. For any of the lenders or servicers who are participating today, we all know that it is, all technology driven, and not a human eye is really on anything until there's a problem and you end up in maybe a default servicing world. But because of that automated nature of the industry, having something out of the ordinary, such as a new flood determination map, unless you've got a system in place for it, and whether that's through your vendor that monitors that for you, or it is your the other companies that you're using to monitor the insurance placement that your customers have, there can be silos that can very much be impacted by new information. For example, if you have a property that gets a new flood map in and it's in default servicing because the borrowers were hit by Helene and now they're having trouble making their mortgage payments, the default servicing folks have to be able to understand what's happening with the flood determination folks. You can also have situations where a borrower who was not in a flood zone before is now in a flood zone, and they're going to have flood insurance. Could trip off all of your lender placed requirements. And if you've got borrowers who are in default or on the verge of default, who are then now being lender placed for flood insurance when they never have before, it's just the coordination among the departments that really can be overwhelming when you're talking about the volumes that David mentioned, just in a single county in Florida.
Yeah.
Yeah, and like we said earlier, the Q&A is, as written, is very complicated with future map-ins. So, you know, you can, possibly get in trouble if you are behind that compliance date. I mean, the date for when it's effective and there's no policy in place. So I suspect that they will try to give some leeway, because I think that we're going to see this more from FEMA. They're developing new technology around mapping. So I think we're going to see a lot more advanced map-ins now, which makes the Q&A clarification Q&A even more important, because I don't think this is the first and last time that we're going to see FEMA do these kind of advanced notices now for as they review the the mapping for the country, which I'm told is very, very outdated at this point.
Yeah, there's definitely a backlog of where FEMA wants to improve the maps, update the maps.
Yeah. The other thing I would mention is that lenders, when they're in this disbursement process of insurance proceeds, there's a lot of people who are, for whatever reason, going ahead and repairing without permits. And I think that's going to come back to haunt a lot of people.
Good point. All right, so I think we're doing okay on time because we've been hitting the Q&As as we've been rolling. But Tashay, I want to touch briefly on the GSE RCV thing, right? That we spent a lot of oxygen on it this year. The GSEs are continuing to gather information on insurance. They sent their surveys. They've really been struggling to articulate an actual problem statement, and industries responded. We've echoed some of the same concerns raised earlier in the process. A number of trade groups, financial services and insurance, have provided feedback to both FHFA and the GSEs. There have been open letters. There's been some exchange of data. There's been public meetings, private meetings. The latest in all of that is the joint trades letter that yourself, Mortgage Bankers Association, the Housing Policy Council delivered just in the last several weeks here. Can you walk, and there's a link, it's the last link on the agenda slide. Can you walk us through that letter and just where we see the issue heading?
Yeah, so yes, on November 18th, we sent a letter over to Sandra Thompson, director of FHFA, asking her to direct Fannie and Freddie to rescind the bulletins that were issued in February 2024, which essentially stated that lenders and servicers must have an actual number for the replacement cost value. You know, we reiterated that there's operational litigation challenges and consumer protection issues that are associated with this bulletin. So they really do need to rescind it. And once they do rescind it, at the same time, just because we do need clarification here, they need to affirm that having replacement cost value or replacement cost language in the policy is enough to meet GSE requirements. Essentially the practice that is in place now. That bulletin that was issued, yes, there's non-enforcement on that right now, but here's the problem. Number one, they're actually still citing people for non-compliance with the bulletins. And two, that does not prevent them from forcing a buyback for not being in compliance with their policies. So essentially you could still get in trouble for not having an actual number on the RCV. So they do need to actually rescind the policy. Is not enough just to have a non-enforcement of that policy. And second, we asked them to rescind the survey. You know, we noted that first of all, the survey was meant to get feedback on our challenges, but the surveyor really just kind of gotcha questions and these very odd system questions that really have nothing to do with the issues that we raised with them. And so we asked them essentially to start first with the property and casualty insurance industry. They are the ones who have all the information that you're looking for. They're the ones who can explain to you the complexities and challenges associated with obtaining a single RCV number year over year. If you need additional information following that engagement, then you can initiate a more transparent and public process with lenders and servicers through a request for information or RFI. And in this RFI, again, they need to outline, as Patrick stated earlier, they need to outline the specific objectives or safety and soundness concerns that they are trying to address with this policy. And then also offer some procedural, practical procedural changes that they think are necessary to address these concerns. So that's essentially what the letter is. It's a 2-page letter, very short. We have not heard from them yet after sending the letter, but we do know they did meet with some insurance trades, so they are starting that process. And Sandra Thompson seemed to be very interested in what they had to say. So we are hoping that we get something soon on this issue.
Yeah, great summary. And it's just a great letter. So that's kind of where we are with the GSEs. So we've got a few minutes left. I'm gonna give folks time. Any open questions, fire them off in the question and answer. But I'll start with one because I don't know, we didn't cover it exactly fully when we talked about New York. I'm going to circle back and probably so for Heather and David, you can jump in here as well. So we've got this bill in New York. We were expecting the governor's signature. It didn't happen live. We were really hoping for a showstopper here during the webinar, but whatever. So assuming the governor signs this, what steps, is it too early? If I'm a servicer, should I be copying my Massachusetts procedures and notice like now, or do I wait? What do I do? If I'm a servicer, what step do I take tomorrow?
I mean, that's a great question. Hindsight's always 20/20. So you don't want to be in a situation where you didn't do it, and then DFS comes to you, Department of Financial Services in New York comes to you and says, you should have done this. I mean, I think at this point, if I were to make recommendations to servicers, it would be start thinking about what's our New York portfolio, what are the obstacles that we may have in and I shouldn't, before I get to the obstacles part, what's our New York portfolio that's in a special flood hazard area? Like what is our population of loans there? I'd want to know what they are. I would want to start looking at, do I have any where we are requiring the borrower to have more flood insurance than their unpaid principal balance? You know, most people in their lesser of 3 calculations they may not be impacted by it. They may not be requiring a borrower to have any more than their UPB. But I would want to know what my potential data set is of how many loans could be impacted. I'd start looking at that, you know, in the new year. That'd be my first step.
Okay. David, anything to add?
I'm a little curious on this whole issue. I mean, then again, I have kind of a different opinion because I see flood losses and flood insurance don't match. And so you get to the safety and soundness issue. And how do you want to handle that? I've always thought that the UPB test, while it's good for the lender, doesn't do much for the homeowner.
Yeah.
It leaves them with a destroyed house that they now have the deed to. So that's a whole different, and I see it different. I see it from a different perspective.
Yep. Yeah. And I see Heather typing a response. One of the questions came in about did we cover the Florida map updates briefly? Yes, but the Florida flood map updates, 88,000 properties, Palm Beach, Lee County, Broward mostly. And it's just, again, it's one of those, we know a number of they're not policyholders now, a number of borrowers will be flood policyholders
Yes, they
in the
will.
future. Yes, they will, one way or the other. And so it's just it's the prep for getting ready.
And it's just the lenders having to do the work and doing the notification. I mean, once again, the agency, the FEMA did the map in, we all get to do the work.
Yep. Yeah. So,
but I think that the other takeaway on the FEMA flood updates is, to David's point, a lot of the maps haven't been updated in 15 years. And Front Street, you know, they've come out with data that in so many years, this percentage of it, I don't want to quote it because I'll be making up numbers, but you know, this percentage of Miami is going to be below sea level. So the maps are behind. And I think that is one of the things that those of us on the, you know, who are the floodies, and especially within the NFA, is at what point or how do we get to the point where we are not looking at a binary, I'm in a FEMA flood zone, so I need flood insurance, versus I receive rain so I could flood. And how do we insure against that?
That's a great question and a great point. And I think the other issue that goes hand in hand with that is, when we've touched on it a little bit today, is Harvey and Helene and some of these other storms where, yeah, you may have been outside the special flood hazard area, but should you have had coverage? So I see Tashale typing a response to the last question that came in. We're coming up on time. If you answered a question and you're waiting, if you submitted a question, you're waiting, just hang on. So when the webinar ends, just stay on so that the Q&A stays open, and we'll get back to you on that. But I do want to, in respect for the time frame and everything, give some closing comments. So on behalf of the board and the leadership at National Flood Association, a big thank you to our panelists today. Heather, Tashale, David, thank you so much. Thank all of you for attending today. A replay of this webinar will be available on the NFA website and our YouTube channel. We have a YouTube channel in the near future. If you have a specific question or want additional follow-up, please feel free to reach out to on the NFA website or through email or LinkedIn. Again, as Layla mentioned, we're a really unique trade group. We represent a wide group of stakeholders in the flood space. If your institution's not a member, please consider joining. The collective voice is so powerful. We've seen that in the comment letter we put together for New York and some of the other work that we've done. We benefit from a very broad coalition. In terms of the work specific to financial institutions on a go-forward basis, we do have a work group. It's open to lender work group. It's open to non-members. We will have a lender breakout at the NFA conference in April. In addition to that, Robert Cole, who's the president of the NFA, board member Scott Giberson, and myself are part of the planning for the National Flood Conference. That's the event in June, sponsored by APCAA and the Reinsurance Administration, RAA folks. So between now and then, we anticipate the key lender issues being the new policy form, the direct-to-consumer program that FEMA is developing, the monthly payment options, and then also we really hope to maintain a constructive dialogue with the regulators on the Q&As. So look for those topics to be discussed at all of those events and at future webinars. And again, a thank you to Layla Taha, our executive director at NFA, Cynthia DiVincetti, who is on the webinar committee and plans and puts all these things together. And of course, Caitlin Tabone for all the logistics support. So thank you to all of those. And Layla, any closing comments?
I think you covered pretty much all of it, which is excellent. Thank you all for joining. There will be a recording available. Wanted to promote the conference. Patrick mentioned it. These few slides will be available afterwards. We're going to post them to the website, and then we'll also send an email out so that you all know when the recording is available and that you can access these as well. Be sure that you also fill out the form. Again, this will be included in the packet.
Yeah.
For your credits.
On CS.
Yeah.
And Layla, last thing, somebody asked in the Q&A whether they would get a copy of the notes. I assume they mean the Q&A.
That too.
Okay.
Yes. We should have the ability to download the Q&A. And in fact, I may work back with all of you just to be sure that we have complete answers if they weren't answered in writing. So if we answered them live, we'll just compile all of that. So that'll be a reference document for everybody as well. Great. And thank you all again. This group, you guys are awesome. This was an excellent discussion. Everyone here is a member of the NFA. All the presenters are, and they're active members. If you have an interest, please check out our website. Please reach out to us. We'd love to have you join us, become a member, attend our conference. We'd love to have you. So thank you again.